The next part is, how about risk-neutral valuation? Because there can be an ideal world where investors doesn't require any kind of compensation when they are bearing risk. So practically, this word is risk neutral. So I don't care that if I'm expecting higher return from risk investment, then it's still considered a safe investment. So I don't care about risk level. And this should not work at all in the real life. But if you are thinking about derivatives, then this can be a really useful conversion, at least at some levels. So what can happen? So if we are evaluating any kind of derivative, we can say that the word is risk neutral in this case. So all the risks are just happening at the level of the underlying product, but not at the level of the derivative. So no further risks are added, like the partner risk of the derivative, so the counterparty risk is not added. That's why they are trying to compensate this at the level of the margins, but not in the pricing equation. So the value calculation in terms of the price of the underlying asset will reflect the risk-return trade-off among market participants. So the value of the derivative is independent of the risk preferences of the investor, but the value of the derivative. So this is really important. That's why all future expected cash flows are discounted at the risk-free interest rate. So that's why we are just using risk-free rates. And no further additional thing is when we are pricing future contracts or options. So what is happening? That we have to follow the following steps. So expected future return on stock is 3%. Expected payoff from the call option will be some kind of money. So the option value will be the discounted expected payoff at 3%. So we have done no further things here. Okay, so then what can we do with forward contracts? And practically here the book says that it doesn't matter it's a forward contract or future contract, just they wanted to simplify everything. So forward contract will be a long forward contract, F, on a non-dividend paying stock. So first of all, we have a delivery price, which can be assumed to be constant, and also time to maturity, T. And the value of the forward contract at time 0, so today, we can say that, oh, there is an expected value at time t, so something will happen in the future. We have a risk-neutral world, and also the discounted at risk-free rate of interest. Under continuous compounding and assumed constant, so this one is not stable in time, will be something like this. So the value of maturity will be, we have present value computation, sorry, it's a future value computation, and also we have that, oh, we are expecting that something will happen, so there will be a distance between the delivery price and the spot rate in the future time period. So if we are taking everything separated, so we are taking the distance in a separated way of this future value computation, then we can say that, oh, the future value of the expected spot rate and the future value of this delivery price and their distance. So everything is in future. But now we can say that the expected growth rate of the stock price in a risk-neutral world, and that's why we have to define everything like this risk-neutral world. In this case, there are no other functions, just the interest rate that it's increasing by this one because no other functions are defined. So that's why we can connect this unknown expected thingy with the spot rate and the future value of this spot rate. So this guy here, and after that we can say that, oh, the future value will be the spot rate minus the future value of this delivery price. And after that, short forward will be the same thing. So all these things are lurking in the background when we are trying to define the forward contract. That's why we have to say that, oh, this is not a word, because otherwise it's so dull that, yeah, we have to have this, but we have to include this expectation or imagination, because, or this idea, because otherwise we would not be able to do this conversion in the equation here. So to say that, okay, spot rates are just increasing because the risk-free rate increases in time, this is necessary to introduce any kind of equation like this. Okay, so let's prepare our MATLAB script for forward contract. We already had forward contracts, but let's make it nice. So, main derivatives. So forward contract for a long one, f equals S0 minus k multiplied by the exp is outside the bracket. Okay, so let's put here a clear command and R ears k equal 80. So this is the value. So this is the value of this forward contract. So it can be familiar. Yeah, on this side of the script, and also short forward contract. Will be the same, just in the opposite direction. This one is minus, this one is plus. And that's all. So, okay, but in this case, we were exploiting this behavior that just price increases because of the risk-free rate, and you must compensate this one. But in the case of the black source equation, we have different behavior because, yeah, what is happening here? We are taking the asset price in time t, and the payoff will be somewhere around this level. So delivery price and the unknown market value, the difference will be determine the payoff. Maybe it will be this thing, or maybe if it's unsuccessful, then it will be 0. So we have two outcomes. And the expected payoff in a risk-neutral world will be something like this. So this is the expected value. So we are taking all the possible outcomes and trying to maximize it, and after that we are taking what is expected from this. And in the case of a call option, then what we have to do is that, okay, let's take the expected payoff and let's take its present value. No, future value, whatever. So we have to take the time value of this, and in the case of the put option, we have the same situation, just now we would like to short sell it, so it's the short position like before, so S is at minus. And after that the logic will be quite similar, that we have to get rid of this expected mark. Just it takes some complications here and there, because first of all, if we have to think about, so the book says that let's first talk about discrete outcomes, and after that we will create nice equations. So if we have two outcomes, so this is a binary option here, and we have some kind of value for the derivative, which pays $1 at time t or nothing, and we have another value of a derivative that pays 0 at time t and otherwise 1, so practically they are mirroring each other in terms of payments. Then if you are buying both derivatives, so as a straddle, then practically we can get this kind of payment. So this is the time value of this. Yeah, it's 1 because it just pays us 1. But anytime it will pay 1. It doesn't matter what is happening because they are mirroring each other, these two derivatives. Right now we have no idea how to value them, just we can say that we can buy at the market this one at, let's say, 100 and this one at 200, so it doesn't matter. Yeah. What happens if we start to add threshold value instead of 1 and 0? So let's develop it further. So now it's an abstract, not 1, but V1 and V2. In this case, the value of the derivative will be the same on this side of the equation, so it's not just multiplying with 1, but now we are multiplying it V, because still we have to say that, yeah, we are compensating ourselves. And after that, if we are just moving this through the equation, then we can see, so extracting this part, and now we can see that how it's related to here and there. We can see that the risk-neutral probabilities will be practically P1 and P2, because this one covers all the possible outcomes. So P1 and P2 says that, okay, this one is happening, or the opposite thing will happen. But this will cover all the possible outcomes of the equation. So this is like a weighted or weight function for the thing. So that's why we can say that, yeah, this is the probability of happening the first situation or the probability of happening of the second situation. So that's why this expression was efficient. So that's why the value of the derivative will be this thing, because now we can say that, oh, it's probability of the first thing, probability of the second thing, this will be the occurrence, that will be the occurrence, but still we have to compensate with the time value to see that, okay, this is the actual thingy here, because this will be paid in the future somewhere when we are reaching time t. So we just cannot believe that. So it's necessary to be added. Okay, so the expected payoff in a risk-neutral world, discounted at risk-free rate, will be that now we have some mutually exclusive outcomes that will occur at time t. So mutually exclusive, that this can happen or that can happen, but not at the same time. Pi as a value of a derivative that pays $1 in the eth outcome occurs and nothing otherwise. So we can see that, yeah, this, oh my god, there is a typo in this one because I'm expressing the same thing with the same thing. Sorry for that one. Yeah. So obviously there is vi because, yeah, and this is p. So we can split it to any kind of multiple probabilities and payments, and it doesn't matter at the end of the day. So and the pi will be accounted that, okay, what is the, sorry, the probability I will be accounted according to the PIs and their appearance in this. Okay, default probabilities can have a similar behavior. Okay, for the next several lectures, we don't care about default at all, but later on we have to talk about this one as well. So, in the case of default, a credit derivative, we can say that a payoff of a particular company can be affected by the default of this company. So they are doing the payoffs until they are not doing it. So we have to estimate the risk neutral default probability, and after that we can say that let's calculate the expected payoff from the instrument and discount the expected payoff at the risk-free rate. So okay, sooner or later we will do this. I can understand why the book was adding this to the game, because if we are defining that what is happening in a risk-neutral world, then this is what will happen. But after that, no further equations were continued here. So they just define something, and after that, not defining any further. Yeah, but what matters us a lot. So this is what is preparing us for value at risk computation or estimation, and also this will prepare us also for expected shortfall later on, because in the case of scenario analysis, we are always looking for the threshold value. So what is happening when we are reaching the threshold value, or what kind of losses can happen if we are for all the things that are behind the threshold or after the threshold. If you are talking about VAR, then it says that, oh, where is the threshold, and all the losses behind them, it's represented by the expected shortfall. So that's why we can say that, oh, 5% certainty is defined by these things. Yeah. So in the real world and not in a risk-neutral world, there is this Girshanov's theorem. So it says that expected growth rates of the market variables change, like stock prices, commodity prices, and so on, but volatilities are remaining the same. Yes, but we know that is not. Okay, so after that, market variable can be simulated in steps of time periods. So if we are constantly sampling for normal distribution, and we can expect that the time series is mean reverting, so it always goes back to the mean value, so it's not creating any kind of sudden trends, or it's not like a Markov process when it can go to other systems. It just behaving nicely. So short-term interest rates, volatilities, and commodity prices are affected by this mean reversion. And variable exhibits volatility, but is pulled toward the long-run average level, usually assumed. So usually we are fluctuating around 0. Correlation between market variables are usually estimated from historical data. Yeah, this is what we will do later on. And random sample from the normal distribution with 0 mean and standard deviation 1. So again, we have this standard normal distribution. That's what. So the book sometimes it always confuses normal distribution with standard normal distribution, which can be misleading because we can calibrate normal distribution as well. Just right now they are lazy to do that. So it will be always 0 and no, sorry, this one is this one is variable sensitive, but otherwise